Welcome to the Stablecoin podcast. We're your host, Luther Madej, head of payments at Algorand Foundation, and Rami Suleiman, president at GMO Trust. We sit down with people building the future of money, operators, regulators, founders, and thinkers. They're shaping how stablecoins move, scale, and serve the world. Well, today we have the pleasure of having the myth, the legend, Nick Philpott, co-founder and head of partnerships at Zodia Markets. Before we get started, though, the views expressed here are those of the hosts and guests and not necessarily reflect their organizations. This podcast is for information purposes only and is not legal, financial, or investment advice. And with that, let's get into it. Nick, it's been a long time coming, my friend. We're so happy to have you here.
Certainly, it's a pleasure. Thank you for having me.
Absolutely. Your background, which is really, really cool from Standard Chartered, etc., talking about FX, can you kind of get the folks started there, where you got started, your time in Africa, etc., and how that kind of led to Zodia Markets?
Yeah, of course. So like many people, I landed in banking almost by accident. I was medically discharged by the British Army in 2006. So without any plan B, I managed to find my way onto Standard Chartered Bank's graduate program. I completed that in the UK, then had a spell of trading African FX in Dubai, a bit of commodity structuring, before, exactly as you said, being based in Standard Chartered Bank, Nigeria, where I suppose that equipped me with an experience, this is about 2009, 2010, an experience of a financial center or a country where the financial system just doesn't operate in the way that we understand financial centers to operate. Doing things like paying for client entertainments in the evenings, was unable to use a credit card because the local telco systems couldn't support the messaging. So you have to use cash. The problem is that the largest denomination banknote, at least back then, is 500 Naira, which is about $4, something in that area back then, maybe $2. And so you have to wear a suit, not necessarily because you want to look smart, that's obviously true, but you need the pockets. And instead of bringing a card machine, they bring a money counter. So you sit there like Tony Montana pulling bricks of cash out of your pockets, and it goes through the machine. Then on the wholesale side, you have situations with lots of failed settlement, usually for quite mundane reasons, but a lot of the processes are manual. So I remember, to the extent of actually marching out of our branch, our office, because a bank down the road had failed to settle, walked down the road past security in the other bank, stormed onto their trading floor and started yelling at the trader, who then probably called his head of operations from some other office to come and settle the trade. We did it there in person. It's not something that I think you would ever hear from someone like who's had a career at JP Morgan, New York, or Nomura, Japan, necessarily.
That's very true.
Physical T0 settlement. I like it.
It's T plus 3 in that particular, T plus 5 in that particular case. But yeah, certainly physical settlement. I've had problems with customers coming and paying option premiums in cash. So then I had to figure out how to get the cash into the bank's derivatives processing system, which is called Murex. I'm pretty confident I'm the only person in Standard Chartered's history, and possibly the history of financial services, to have ever successfully done that.
That's fantastic, Nick. I think what would have made that visual even better is if there was a suitcase and like a handcuff or something that was tied to, what I'm saying, like that you walked around with, like that visual would be fantastic.
It was far less glamorous. It was a white envelope, and it sat on my desk for 3 days while I tried to get the cash into Murex. Horrendous experience. But it's probably also, just sort of back to the original question, it's probably meant that I have quite a visceral drive when it comes to digital assets, and actually really understanding what the opportunity is, and the improvement that it can make in both the micro scale, so for individuals who struggle to get access to banking, struggle to get access to credit, and at the macro scale, so making cross-border trade cheaper, faster, and simpler.
Yeah. One of the quotes that you've said in the past that I love, which is, cash is slow, unpredictable, and expensive. And if you ran email like you ran cash, that'd be insane. And you're absolutely right? And so, I feel like some of that is probably where Zodia Markets was kind of born out of. And can you kind of help us understand like Zodia Markets and like the access to stablecoins and digital assets from that perspective?
Yes, Zodia Markets is a majority-owned subsidiary of a British bank called Standard Chartered Bank, which, as I mentioned, is where I used to work. So British headquartered, specializes in emerging markets, Asia, Africa, Middle East. It's about 175 years old and has its genesis very much around cross-border trade, particularly in the Anglophone Empire, effectively, the British Empire. So Zodia Markets is originally a partnership between Standard Chartered, which is the majority, and then a company called OSL, which is a exchange brokerage operator and custodian in Hong Kong. Is where our CEO and my other co-founder comes from. We commercially launched Zodia Markets out of the UK in September 2022. And over the time, we've kind of managed to identify where our niche really is. And as you guess from my presence here, that it is around stablecoins and being able to provide what we call on and off ramping. So being able to onboard a customer, take cash from them as part of an FX style trade. They give us cash, we give them stablecoins. Or vice versa. What we're doing on the other side is we are onboarding with all the stablecoin issuers, so we can directly mint and burn, issue and redeem, buy and sell, whichever phrase you want to use. And on the other side, we're doing foreign exchange trades with Standard Chartered. Now, if I sort of turn my focus on the rest of crypto, most of crypto started very much from a retail background. Coinbase was very much a retail exchange. The same goes with Kraken, Binance, and so on and so forth. In addition, if you look at a lot of the teams, in a lot of the sort of the DEXs, the tech providers, the stablecoin issuers, there's definitely a sense of a sort of West Coast mentality, West Coast US. That's not meant as a criticism, it's just a sort of cultural thing. It's very much focused on retail payment apps, retail payments, mass consumer payments and those sorts of things. So Stripes, the World Pays, and that sort of thing, Remitly's. I come very much from a wholesale world of wholesale foreign exchange. So we are moving millions in a single ticket rather than single figure dollars. We are dealing with oil companies and shipping companies, mass consumer goods companies. We're not dealing with Airbnb, Etsy creators and paying Uber drivers. There's two legitimate worlds for that. What that's meant is that a lot of crypto has approached traditional finance with very much a retail mentality. So they've gone after real-time payment systems, which as the name implies, provide real-time payments, but they're capped in terms of the notional. So it's perfectly good if you want to pay an Uber driver, but the moment you need to pay for a shipload of crude oil, you've got a problem because those systems are capped. That also makes life easy because stablecoins work 24/7, so do mostly real-time payment systems. What we're doing is the much harder yards, much harder yards, which is opening bank accounts, foreign exchange trading relationships, mostly with Standard Chartered and other partner banks, whereby we're getting access to the wholesale clearing systems. So yes, we do have some real-time payment systems, but we're going for the wholesale because we need to be able to put through payments, for a VLCC tanker of crude oil is kind of what we keep in mind in terms of the maximum trade size, 2 million barrels of crude oil multiplied by the price of oil. So whatever that is, it's $130 million, give or take at the moment, maybe 140. And we've also managed to overcome, I suppose, quite a lot of the hostility that a lot of banks give to crypto companies. It's still vanishingly difficult for a crypto foundation, a stablecoin issuer, a crypto exchange to get even basic bank accounts. More often than not, if you look at the banks that they're using, they're often glorified payment service providers or pretty small banks that you tend not to have heard of, which themselves have quite frail and skittish access to clearing. So I think that's the big problem that we're solving. So quite a long answer to your question, but hopefully that paints a good picture of who we are and where we come from.
It absolutely does. It absolutely does. One of the things, and maybe I'd love to get your perspective, and Rami, feel free to jump in, which is the larger the ticket size, right, in today's world when it comes to digital assets, what I've noticed is that liquidity becomes an issue, right? So like, for example, USDT to Mexican peso or USDC to Filipino peso, or even, it's fine when you have a couple of zeros next to that one, but the moment you add, in your case, 6 zeros next to it, like the FX rate looks not so good. And so how are you guys solving for that?
So there's two different types of liquidity. There's settlement liquidity and then there's execution liquidity. I should probably put those the other way around. So on the FX side, if you're trying to buy $100 million worth of pounds or Swiss francs or yen, you're going to be fine. Those markets are very broad. There's lots of banks. There's huge amounts of liquidity. There's a decent amount of credit in that system. and the underlying clearing systems provided by the central banks are pretty good. Euro would be another one. So G10 collectively, you're going to find it's going to be fine. Then you get into Central and Eastern Europe, sort of some deliverable emerging markets, so Turkey, Kenya. You could probably argue South Africa and a bunch of others are going to be in this sort of group where it's going to start to get a bit harder, but the currencies are deliverable and you're generally going to be fine. Then you've got much larger currencies which are not deliverable. Indian rupee, Chinese yuan, Indonesian rupiah, and so on and so forth. What does that mean? It means, broadly speaking, I'm going to struggle to buy dollars using those currencies. I can't sell Chinese yuan and just buy dollars as I see fit because the government's going to have a limited number of US dollars. There are usually restrictions on buying dollars. I would often have to present documents to the government, go, look, I'm importing crude oil, widgets, grain, whatever. And then the central bank says, yep, that's fine. So I'll sell dollars and give you the dollars and you can give me the Chinese yuan back or whatever it might be. Then you get into the sort of frontier currencies. So, the Azerbaijani manat, the Mongolian tigrig, the Paraguayan guarani, I could keep going. You get the gist, where the currencies are very, very small. The foreign exchange markets are tiny and just liquidity is very, very difficult. The other part of liquidity is settlement liquidity. So it's how much cash sits in the settlement systems, i.e. it's put in there by the banks that you're using, in order for you to be able to settle the trades that you've agreed. Okay, so the first one was execution. That's just trying to be able to identify a price. So that's price liquidity. The second one is settlement liquidity. Crypto's got that arguably in much, it's a much more significant risk to the system because stablecoins move very quickly. So they're going to settle anywhere between sort of less than a second to sort of double figure minutes. So what that's going to do is that's going to reduce what we call counterparty settlement risk. So if I've agreed to sell stablecoins to Rami and he's going to give me cash, because the stablecoins are going to settle very, very quickly, the probability or the likelihood that we're going to be waiting around for the trade to settle is far less. The slower part is always going to be cash. Okay. Now, the challenge that creates is that your capital liquidity risk has gone up. Okay, so counterparty settlement risk has gone down. The likelihood that Rami screws me or I screw Rami has gone down because the amount of time we're waiting to settle has gone down. But it means I have to fund what I'm going to give him and he has to fund what he's going to give me. Okay, so that means that your funding has got to be significantly better, whether that's a credit line or using huge amounts of balance sheet, or if you've got other trades that are going to deliver to you, you've got to be much, much more efficient with the way that you handle your balance sheet and you handle your liquidity. So again, this is something that we do. We specialize in. We have credit lines from Standard Chartered. We have a decent balance sheet. Just done our Series A. That's going to be announced hopefully very soon. And that then allows us to mint and burn with the stablecoin issuers with a high degree of velocity to deliver to our customers. And then also we've got access to a proper clearing bank in all of the 21 foreign currencies that we currently offer. And that allows us to settle very, very quickly. I suppose the last one is actually on the stablecoin issuers side. So if I'm a stablecoin issuer and I've got $100 billion worth of market cap, whatever it might be, then I'm going to need X amount to honor redemption requests during the day. So people come along and go, I've got stablecoins, I'd like some cash back. Here are the stablecoins. And I go, well, hang on a minute. I can't give you $3 billion worth of stablecoins because I've tied 98 or 99 billion of it up in treasuries. So I have to sell the treasuries, get the cash from the people who selling me the treasury, I'm selling the treasuries to, and then I've got to give you the cash. So there's a degree of liquidity management that the stablecoin issuers have to do. And then they have to split that across multiple banks. So if I take Circle as an example, so they mint and redeem out of the United States, out of France, and out of Singapore. So they've got to have cash at all three of those locations to honor redemption requests at each one. So there's a degree of trying to guess, are redemptions going to come in Singapore or are they going to come in the United States? Is it the same every day of the week, or does it tend to be one on Monday and a different one on Friday, and so on and so forth? And they've always got to make sure that they have more than enough, because the moment they're short, they're in trouble. And it all points to the fact that running a digital assets business, whether it's a stablecoin issuer, whether it's a broker, whether you're just using stablecoins, the hardest part is always cash.
You're absolutely right. Go ahead, Rami. You have a different perspective on this.
Yeah, no. I was going to say, I think the advantage that Standard Chartered have is the quality of their FX franchise, particularly in the frontier currencies and EM markets, makes it a particularly good partner for Zodia. So I think in terms of the edge that Nick has in terms of servicing this audience, particularly in those currencies, really comes to the forefront in those pairs. And then I guess the other thing that I wanted to mention and see what your thoughts on. We're still very early in this evolution where people want to go from cash into stable coins and then back into cash. How soon do you think we will get to a point where people are going cash into stablecoins and are comfortable just to leave their inventory and balance sheet on chain in stablecoins? Because that you mentioned, cash is the hardest leg. That's fine. But how soon are we going to get to a world where people are just comfortable engaging in stablecoin commerce and using stablecoins and comfortable leaving on the balance sheet to do their trading? What are the impediments? What do we need to get that situation going?
Well, in some senses, we're already there. But as with, I suppose, many of my answers, it's going to be which people, what use case. So if I look at the big crypto exchanges, so they're already sitting on very large amounts of stablecoins. And this obviously has its genesis in the history of a lot of those exchanges where they were struggling to get access to basic banking. And even if they did get access to banking, the cash isn't as fast as the rest of their business. So I've got a business where crypto and stablecoins are flying around, settling T0 in minutes. I'm trying to run cash where the cash moves sort of T+1, maybe. Then it's a complete nightmare. So sitting in stablecoins to manage my own treasury makes eminent sense. I'm also not regulated as a bank, so I don't really care about prudential regulations, because one of the biggest problems, the elephant in the room, is the Basel rules on the prudential treatment of crypto assets, which is very, very, very punitive. And at the moment, I think quite a lot of stablecoins still fall outside of the sort of the categorization where a financial services company, a regulated one, could hold stablecoins on balance sheets. Certainly, we still struggle from that point of view because we consolidate to a bank. There's some advantages, there's some disadvantages. The second group is more on the micro level. So if I'm in a developing country and my local currency is basically being inflated away, just being continually debased. So every time that I try to save money, I just discover that, oh my word, relative to the US dollar, 40% of my savings have just gone up in smoke. So I'm effectively just giving free labor to effectively the central bank. So I'm effectively just being fiscally oppressed. So actually now being able to hold stablecoins as an alternative savings method is going to be very, very compelling. Argentina is probably a very obvious example. Argentina has a bit of a history of manipulating its currency. I think at one point it had somewhere between 3 and 5 different foreign exchange rates. It is public knowledge that after the United States, Argentina holds more physical paper US dollars than any other country on earth. Why is that? It's because they're stuffed under mattresses. They're buried in plastic bags in the jungle. Because that is a savings account for many people, which is a massive indictment of the banking system in some of these jurisdictions. That obviously has a risk. It could rain, the bag could split, your savings could rot, someone could rob your house could burn down, all of these things. So holding physical cash is a pretty precarious way of trying to safeguard your life savings. It's also not going to pay any interest. So if you can hold digital dollars, which are effectively available to anyone who has access to the open internet, then I think now you have a very meaningful escape route. So that's on the micro level. On the sort of corporate treasurers side of things, I think it's still early days, certainly in terms of the majors that we deal with, so big agri, big oil, tobacco, mass consumer goods, maritime, all of those guys. What they're looking for is to buy stablecoins, use them for the specific use cases that they're targeting, which is not to replace all of their payments. It's to fix the 20% of their payments that cause them 80% of the headaches. Yeah. Sending cash from New York to the UK or Hong Kong to Singapore is easy. Trying to get someone in Nigeria to pay a bill is very, very hard. And that's not the Nigerian guy's fault. It's because he's sitting there in a central bank queue waiting for the central bank to sell him the dollars. Or alternatively, he can just go to a local broker, local exchange, offshore exchange, whatever. He can buy the stablecoins and boom, he can pay his bill. Commerce can flourish. So it's just a very simple example use case, or fixing demurrage, so being able to pay for ships the moment they arrive in harbour rather than thinking, oh my word, the ship's arrived on Saturday, I can't pay until Monday, so I guess that means I'm renting the ship at $50,000 a day until Monday. So it fixes quite trivial use cases. Part of the inhibition to that is lack of understanding. So they're confident to be able to hold the stable coins for a very short period of time. A failure of the accounting fraternity to deal with stable coins and saying that it should be treated as intellectual property is frankly a joke. Saying that it should be treated as inventory is sort of questionable. I think at the moment it's falling between lots of different stools. So someone actually getting a grip of that would be very useful. The legal ownership in some jurisdictions is also a bit questionable as to whether digital property is actual property. So in the UK, the Law Commission has done a phenomenal job of addressing that problem. And then at the more mundane level, just working out taxes, although many tax authorities are quite happy to tax crypto, including in those countries where crypto is banned, which is a delicious irony. And the other one at the far more mundane level is just getting the enterprise resource planning systems to accept stablecoins. So, you could use companies like Fortress, for example, who've got integrations into ERP systems. I think Fireblocks do. Our sister company, Zodia Custody might, I'm not sure. But a standout one would be SAP. SAP has a digital currency hub. You can Google it, so I'm not saying anything I shouldn't. I think that is a fabulous endorsement, and it's great to see some forward thinking from one of the major ERP providers.
That's actually interesting. I did not know about the SAP piece. I want to pivot a little bit here. So I think, would you guys agree that most of the conversation that we've had thus far is around potentially US dollar stablecoins?
Yeah.
But, going back to Rami's question, I think the propensity to hold stablecoins may actually go up with what is the next wave of stablecoins, which are the local currency stablecoins, right? Like, I want to get your thoughts on that. I feel like that'll increase the propensity to hold, and I feel like that also solves for some FX, risk from some perspective. But Nick, what do you think?
It certainly fixes your accounting problem. So, I mean, if you're a company that accounts in Turkish lira, for example, then holding dollar stablecoins all over the place is going to cause you a bit of a headache, particularly with the volatility of the currency. You're going to have to, the Turkish lira versus the US dollar, you're going to have to continually mark that to market. As we say, in plain terms, you're going to have to continually reprice it, which is a nuisance. So far we found 26 currencies globally that have a stablecoin of some kind. And what we're gradually trying to do is we're trying to onboard at least one stablecoin for every single of the 21 currencies that we currently support. I think we're about 10 or 12 so far. Rami's GN and ZUSD is two of them that we support, for example. And we're gradually iterating through, because we won't just onboard any old rubbish. We have to do a proper assessment. We are owned by a bank. We do things the right way. So we look at the structure, the risks involved, and all those sorts of things. So I think that's fine. It's probably slightly counterintuitive as to where the opportunities really are. So, as you would rightly guess, US dollar stablecoins are by far the biggest currency that we trade as a company. And that's probably true of the rest of the market. What comes as a bit of a shock is what number two is. So we've traded somewhere, it depends on you count it, but anywhere between sort of 20 and 30 billion of US dollars over the course of this year, so far year to date. So getting towards the tail end of July. Number two, at about 2.4 billion, is Turkish lira, TRYB. Now, most people would think, well, I would have expected euro, yen, possibly CAD, sterling, something like that. Now, the way that I would explain that is that if I'm in Singapore or Hong Kong or Sydney or South Africa or wherever, I could open a euro bank account pretty easily. I can open a sterling bank account probably fine, Swiss, and so on. I could go through G10. If I want to open a Turkish lira bank account anywhere outside of Turkey, I've got a bit of a problem. And so what we're finding is that it's allowing us to be far more efficient in terms of settlement. Some Turkish banks, particularly the banks that crypto firms are able to get access to, are unable to get access to SWIFT, or where they do have access to SWIFT, it's often 1 or 2 steps removed. So it can be quite slow. Turkish lira stablecoins provide quite a nice alternative there. From a Turkish perspective, I think where that's very interesting is it's going to mean, to me, inevitably that the Turkish lira could become, once again, I should add, a regional currency. So if I just rattled off a quick list of countries that are countries now, but when they were part of the Turkish Empire, used to use the Ottoman lira: Greece, Albania, Serbia, Syria, Jordan, Palestine, Israel, Saudi Arabia, Yemen, the list goes on, Iraq, Kuwait, and so on. That Ottoman lira was broadcast because the Ottoman Empire controlled many of those jurisdictions, and maybe on the periphery it was still used. It was probably quite used heavily in the Caucasus, and certainly in Ukraine. There's a huge amount of Turkish influence from Bessarabia, which is now Moldova. So the empire was the delivery mechanism. Okay, now you have a situation where the internet, the open internet, is the delivery mechanism of your currency. So is it in Turkey's interests to turn their currency into a regional currency? Don't know, probably. But I think it makes sure that Turkey's going to have a good deal of influence over the course of events. It's going to have a strong currency, or at least an influential currency. I think strength can be measured in different ways. So I would think that that's going to apply to I think there are opportunities with other currencies and other countries to become regional players. The United Arab Emirates is a great example. Saudi would be another one. Kenya. I think the list goes on. Brazil. So I think there are huge opportunities there with some of those non-dollar stablecoins. From our perspective as a financial services provider, I think it gives us an opportunity to reinvent the way that foreign exchange works, which again is kind of archaic. One of the problems with managing foreign exchange, let's say I'm trading dollars versus Japanese yen, is that the central bank systems that move dollars and move yen, so Zenga or BOJnet, depends what you want to call it, and Fedwire, are not open at the same time. Whether it's operating hours, one's in Japan, one's in the US, they have different holiday calendars and so on and so forth. They are open at the same time for about 3 or 4 hours a day. So that's the only real time where I can do what we would call payment versus payment settlement, whereby the yen is going to move at the same time as the dollars. And you're going to be able to link the two transactions and thereby reduce the risk. Otherwise, we run a risk that was discovered in 1974. I'm sure it was understood before then, but it became a really big problem in 1974 called Hofstadt risk. Hofstadt Bank, German bank, went bankrupt during German hours. Unfortunately, it had delivered all its or received all of its Deutschmarks because the Germany was open, but it hadn't transmitted the dollars out because America hadn't opened, because it collapsed in the German morning. America was shut. So unfortunately, lots of people wound up being owed lots of dollars by a bankrupt bank. So that created Hofstadt risk. So you need both legs ideally to move as close to each other as possible. You can't have one in the morning and the other in the afternoon. You just hope for the best. Stablecoins, by virtue of jettisoning those two central bank systems, by virtue of them being on the same chain, the same infrastructure, means that you have opportunities to move them at the same time. Blockchains don't have any operating hours. They certainly don't take holidays, and the settlement speeds are significantly faster than going to a bank that then instructs at the central bank clearing system, which then settles. I think also in the fullness of time, we'll see other asset classes start to move onto that infrastructure. So every man and his dog is talking about tokenization, from bonds to carbon credits to private credits to real estate to heaven knows what. The core problem that none of them are fixing is cash, because cash is usually one of the legs in all of those transactions. So it's all well and good if you can tokenize your carbon credit and you can move it at the speed of email any day you like. But if your cash doesn't arrive until 2 business days from now, you are literally where you started. If you fix cash, you fix everything else. I suppose one very quick sort of last word on just what the alternatives are. So central bank digital currencies won't work because you'd need to make them interoperable. So it'd be similar to the central bank systems I described earlier. You could certainly try to make them interoperable, but with 180 currencies in the world, that's, 16,100 bilateral combinations. It's quite a lot.
Did you just do the math in your head just now?
No, I've done it before.
That's scary. Okay.
Yes, no. I did history, not maths. So I've done that before. So it's a huge number of bilateral combinations. And you can go, well, we'll just network them up. The problem is that CLS, which is a means of trying to address settlement risk in the foreign exchange market, has been doing that since 2002. Over the course
Not
of
for
that
all
time,
currencies as well.
23 years, they've managed 18 currencies. So at the current pace, they'll complete the 180 currencies in the world in about 200 years' time. It's not going to happen. So central bank digital currencies could have a domestic retail application, and you might get lucky and you might create some bilateral connections. I could see the Swiss and the Euros getting together, or the Polish and the Europeans, possibly Hong Kong and Singapore, but it's not going to be big. And you're going to have to, unfortunately, deliver the hard news to a lot of countries. Terribly sorry, your currency is not sufficiently, is too small. You're just going to get left behind. The second group will be tokenized deposits. That's going to work very well for the banks that create it in terms of making their existing clients stickier. But it's not going to fix cross-border payments. It's not going to fix cross-border settlements because it's a closed system. If you make it open and you put it out into the open internet, it's going to be great fun to trade, but it's going to be useless because it won't trade at par. We'll be back to 1870s US wildcat banking, because I would not value JP Morgan coin the same as I would value the tokenized deposit coin of the Bank of Podunk, Texas. One's going to trade at 99, the other's going to trade at 60. Okay, they're not fungible. So the next one is security tokens. They're not going to work outside of possibly the regulated sphere, so possibly as collateral movements for existing banks, but I don't see them being used for what we're seeing stablecoins being used for, which is cross-border trade, remittances, and all that lot, because they're regulated as securities. We're onboarding with a couple now. It's a complete pain. You have to become an accredited investor from various others. You have to demonstrate that you've got $5 million in your bank account. So that already restricts your potential audience quite significantly. Everybody's got to be KYC. Settlement is a complete nightmare, and it's all rather horrendous. Stablecoins for me, it's just the most obvious thing. It's going to work. And with the passing of the Genius Act, I think now the wind is in the market sails.
There's a lot to unpack there, isn't there?
Are you starting to see so beyond the larger transaction sets that Zodia Markets handles on a daily basis, which is, like you said, usually paying for oil or large shipments of something, right? Coffee or something. Are you starting to see where stablecoins are being used for the more delivery versus payment in the kind of cases like tokenization, like RWA stuff, like real world asset tokenization?
No, not really. So most of our clients are coming to us to fix real world problems, I would say. So, I think they all sort of accept that tokenization and of real world assets, so tokenizing the coffee or tokenizing the oil, is certainly the future. But at the moment, they've got so many problems with cash in so many different places that you've kind of got to start there. And for many of them, corporate treasurers are not incentivized to be creative people. It's probably the one department you want to not be creative. We've discovered a great new investment for all the corporate treasury. What? You didn't invest in it, did you? You want it to be boring. And for many of those guys, the way that we're managing to get into them and managing to get adoption from them is to find the thing that, and to put it crudely, that they hate more than they hate crypto. Okay, and they hate crypto because they see it in the front page of the newspapers, this scandal, that scandal, Sam Bankman-Fried, FTX, 3 Arrows Capital, Terra Luna, all of that sort of stuff. So it's usually quite a visceral but uninformed response. And I think now, because of a lot of the educational work that certainly the Stablecoin Standard and other foundations, Algorand Foundation, have been doing, those hard yards, I think they're starting to get a little bit more comfortable. And they're also seeing adoption at the ground level. Because let's say you're a corporate treasurer in, I don't know, Argentina, use that one again, and you notice that Granny is receiving remittances from her nephew in New York with USDC, or you see that loads of people are using stablecoins as a savings account, or if you're a corporate treasurer in Bolivia, a lot of copper there. I've got a photo of chocolate biscuits priced in Tether in La Paz airport in Bolivia. So if you're walking around and you start to be surrounded by more and more of this stuff, you start to think, hang on a minute, maybe I'm missing something here. Okay. And the adoption in many of the emerging markets is now quite significant, where some of the oil majors and some of the agri traders and the maritime companies, they've got farmers cooperatives in LATAM or in Ghana or wherever else going, I can't get access to dollars. Opening a bank account is more or less impossible here, certainly in a dollar bank account. Can I just pay you in Tether? And so we're now getting agri traders coming to us going, to us literally, I don't know, can I? And you go, yeah. So farmers cooperative sends you the Tether. We will then convert that into euros for you or dollars or whatever it is you want, and off you go. So I think that's where we're starting to see much more significant adoption, and I think in the fullness of time we'll start to move to the real world assets. But I would almost appeal to the crypto fraternity, focus on real world problems, not real world assets, or tokenization of real world assets. Just fix the basics. And some of the stuff that we're coming across, like in the maritime industry, is just, the use cases are so obvious that it's calling. I mean, here's a lovely one. Dry dock. So you've got a ship in dry dock, scrape the barnacles off, check it for holes, give it a good service, polish it, I don't know, whatever they do. And then the dry dock comes to you and says, right, your ship's ready. Can you pay? And then I'll release your ship. If your payment fails to clear before the tide goes out, your ship's stuck for another day. Guess who's renting the ship for the next day? You are. That's $100,000 bill. You don't pay that bill on time, you stay for another day. And on and on and on. It's such a basic problem.
You're breaking the dry dock cartel. I mean, Luther and me own some dry dock companies. I mean, unbelievable.
Yeah, exactly.
That was our next investment, actually.
Yeah,
the dry dock
exposed. I can't believe that.
That's your weekend job, is the scrap guy just there with a blowtorch and the side of a super tanker.
That's got to be cathartic in some way or the other, right? Like, I mean, instant gratification.
Exactly. But these use cases are so trivial and they're so basic. That's where we see a real opportunity in having the patience to sit with the treasurer. I had this morning, treasurer from an industrials company, and he just said, we're novices. We know we want to start using stablecoins because our customers are asking if they could pay us in stablecoins, and they take 3 months to pay us in cash, but they could take 3 days to pay us in stablecoins because that's how long it's going to take them just to gather up the liquidity from the local exchanges, and we're off. And we're talking $30 million tickets. So these are not insignificant. But he just said, could you just do some training courses for us? Just, what is this? How does this work? What do we need to be aware of? Are there any other suppliers that we should think about? How do we think about the compliance, the AML, all of the controls? How do we keep ourselves safe? And so on and so on and so on. I think that's where it would be a call to arms, I think, for most people in digital assets, is to have the patience. These people have finally come around. We probably all start to feel that we were all very jolly clever and we thought of it first. But I would really encourage people, send the rope ladder down and help them climb up.
Yeah. I mean, I feel like education is so important at this stage. Just as we're getting the legal clarity globally through Genius as a good example. So, but actually, I think you're absolutely right. The most pressing adoption need is in the areas where this is a game changer, not a nice to have novelty, and that's where I think education is so key. I mean, do you remember, Nick, when we spoke, Luther, about 8 months ago at the ACI World Congress? So ACI is a organisation for effectively all the banks, and a lot of it is sort of emerging country banks. And we were giving a fireside chat. It was in Jordan that year. Nick were doing it from Abu Dhabi. It was, like talking to them about fire or something, something completely new. And they had very, very, and these were extremely intelligent guys from the Bank of Jordan and, Arab countries which would have benefited extremely well from utilizing stable coins as an alternative. I think a lot of them see them as threats. And the problem is that it's an alternative rail where the current infrastructure is not fit for purpose. And I think, thinking of it as an alternative rather, we live in an and world, not an all world. This education journey, we're right at the beginning. I think those are the people who are actually in control of the treasuries at the bank. And I think, Nick, we also went to, or you kindly invited me, I went to the Associated Corporate Treasurers event last year in Dubai. And I was wandering around. This was in December. I mean, this shows how quickly things have changed. I was wandering around in December from stand to stand, and all the big banks were there, and you had all of the corporate treasurers of companies like ADNOC and Emirates, and all these sort of large-scale companies that would probably benefit from utilizing stablecoins in some way, shape, or form, given the international commerce that they do, and you try and have a chat with them about it, and it was like, no, this is crypto, this is wrong, we're staying away from this is risky. And it's like, no, but okay, fine, we need to just have we need to start at first principles. And I think we're now getting that legitimacy. And, now I'm seeing in the UAE news stories where I think Air Arabia is using the AE coin, which is the AE dirham stable coin, as payments. The taxis in Abu Dhabi now are using stable coins. So it's happening. But the rate of change, I've actually been surprised at the speed of that rate of adoption in places like this. I have another point, actually, Nick, that I wanted to ask you before you, which was how do you see the pegged currencies? So I was thinking about your Turkish lira regional dominance, because I thought that was mainly a one-way trade, which is people in Turkey want to have access to dollars. This is the sort of the Argentinian example, the Lebanese example, inflation hedge stuff. But what you were proposing is something quite different, which is actually, the Turkish manufacturers, the Beko and all these guys who have quite big trade and have people paying for their stuff, actually want to accept, a synthetic lira as their payment mechanism, and that's the way that people can exchange and pay for goods. Is that what you're sort of proposing? Is that where you think that could be heading?
Well, certainly, or Bayraktar. They even made a song about it a few years ago. So good Turkish corporate there. Yes, for the pegged currencies. So the whole point of having a peg is if you've got an economy that's quite heavily exposed to a particular commodity, so oil is the most common one, then it does make logical sense to be pegged to the US dollar. But by having your own national currency, you're still retaining what is effectively an option to depeg. Okay, if either your currency strengthens too much or weakens too much, you've always got that kind of, if in case of emergency, there's a hammer in a glass box, and you can get that out. We have quite a lot of customers who come to us and they specifically ask for Tether. Why do they ask for Tether? It's not because there's any criticism of USDC. It's a phenomenal team. It's a well-designed cryptocurrency, regulatory first, all the rest of it, fabulous IPO. They do that because they see Tether as a little bit more of a euro dollar. Circle is fundamentally issued by a US entity. Okay, yes, it's issued by a French entity and a Singaporean entity, amongst others, but this is fundamentally an American coin. Some people just feel a little bit uncomfortable about that. They want the dollar, but they don't necessarily want the exposure to, how would I put it, potentially the fickleness of American politics. And I'm not saying their politics are any better than ours or anyone else's. I mean, British politics is particularly horrendous at the moment. So it's almost just having that extra step away because Tether is issued by a non-US company. And I think that has a parallel in history. So the euro-dollar market, invented in 1955 by a Brit called G.I. Williamson from memory at Midland Bank. And then it continued on. The Soviets used dollars in non-US banks because they were worried about their dollars being seized. G.I. Williamson was trading and affecting loans, effectively using the swaps market, using dollars that were in European banks as opposed to US banks because of the cost differential. That continued. Eventually, you have the petrodollar market in 1974, where the Saudis agreed to price all of their oil in dollars. Jettisoning the pound. I feel like I'm making this answer quite a lot about sort of the chastisement of Great Britain over the course of the last 70, 80 years. Anyway, so you have this huge
culminating in us leaving, actually, Nick.
Exactly. two emigres. But yeah, so you've culminated with this huge market, which is used for funding, for loans, for cross-border trade, and so on and so forth. I think Tether is in many ways a parallel to that because it feels like a euro dollar 2.0. And I think there's a place for both. There are people who would prefer to have a US issued currency or a US dollar. There are people who have preferred to have a euro dollar version. I think the opposite of a good idea could also be a good idea. It doesn't necessarily mean that the opposite of a good idea is a bad idea. I think it very much in consumerist terms.
I was thinking that there's two here, though. So you've got sort of the dirham, which is a dollar, effectively an Arab euro dollar. You've got the Hong Kong dollar, which is an Asian euro dollar, effectively. And you've got stablecoins in both, and actually progressive stablecoin regulation in both countries. What are your thoughts on how are they going to proliferate? I know they've got different use cases, but how do you think the interplay would happen, and what do you think? Where's Zodia best placed? Because you've got regional concentration in both places, actually. So what's your take on this?
Yep. So I mean, the proliferation is going to happen via the open internet, as is the case with most stablecoins. So that's the easiest thing. I mean, I would see the best chance of expansion is going to be through good regulatory structure, which the UAE has in spades. A thriving sort of business and startup culture as well, plus also banks that are willing to provide basic banking services to the startups and to the issuers and to the digital asset companies and things like that. I'd say the UAE is not perfect here. I'd love to see some of the bigger banks, so Bank Fab and ADCB and ENBD and so on, start to become a little bit more engaged. I think that you probably it's almost like an inverted pyramid, a little bit too much on a particular bank. So that will improve. And then
I would say Fab is already issuing its stablecoin now. Fab's doing dirham stablecoins. They're starting to go in the right direction, I think.
It is, exactly. So I'd characterize it that way. So I think we're now onto a very positive trajectory. Whereas in some other jurisdictions, I mean, I'll call out Ireland. We set up an entity in Ireland. How many Irish banks would bank us? None. In spite of the fact that we ourselves are owned by a major international bank. So you can have the best regulations, you can have a decent employment environment, but if I can't get a bank account, I can't run a business. It's as simple as that. You need all three. And so that also flies in the face of that whole notion of if I have the best regulations, then the market will flourish. No, it won't. You need all three. Yeah. I think the UAE particularly and the Middle East is definitely demonstrating that it is playing to win. I think it is definitely winning. The United States, I think, now is really going to breathe some air into the flame of that sort of. It's going to stoke the fire of all that innovation globally. It's going to jolt quite a lot of central banks out of their torpor. So just in the course of the last couple of months, we've been approached by a few central banks who know us through Standard Chartered and various other angles. And they go, yeah, we want to talk about stablecoins and putting in and starting to adopt stablecoins. I'm sitting there going, hang on a minute, isn't crypto banned in your country? And they're like, yeah, don't worry about that. Regulation, we're going to write one, and it's going to, all the rest of it. So we're seeing people turning around on a dime. Having a pegged currency, it does seem counterintuitive to have something that's pegged to something else. So a stablecoin that's pegged to something that's pegged to the dollar. But again, it's about having probably that little bit of extra distance from the US if you wanted. So if I give you an example, so a lot of trade finance is now financed in dirhams. Looks like a dollar, acts like a dollar, but it's not a dollar because you can go to a UAE bank and you're able to get financing. Okay, so I think we're going to start to see the Middle East really, and I hope, flourish because it should be rewarded for the courage that it has taken. It was going in the opposite direction when the press, a lot of the other regulators, both the supranational regulators and some of the other major regulators, were going in literally the opposite direction. Credit where credit's due.
So we talked about the adoption of corporate treasurers, right, with the coming of the Genius Act, etc. I remember I had a conversation one time with a CFO that said to me, I'd love to talk about USDC, but my systems have only 3 letters. Right. So I can only do USD, JPY. there's no place for an extra C in my systems,
Yep,
right?
yep,
So
yep.
so when you talk when you think if when a treasurer whose boss is like, or whose CEO is like, hey man, like we're missing the boat, like we need to do something about this stablecoin stuff, like what kind of advice do you have? Like what's a good starting point for them? Like where'd they go?
So we had the exact same problem with Murex and various other systems in Standard Chartered with Libra. ex-US, problem solved.
Ah,
Um,
okay.
and if you go into the systems, I'm pretty sure, I don't think I'm revealing anything I shouldn't, um, uh, XBC or XBT, I can't remember, and XET, Bitcoin and ETH. That's how it goes into the systems. So yeah, if you're a stablecoin issuer, you need to be talking to those banks quickly, and you need to get your dibs on the ex-US as quickly as you can.
Yeah.
And if I'm a developer, if you're at the ERP system providers, or you're at Murex or Broadridge or whoever else, Wall Street Systems, just think about adding another character, will you?
Yeah.
Yeah.
Yeah, absolutely. I have another question actually for you, Nick, which is the problem with stablecoins, I guess, it's quite a fluid and versatile instrument. So, cash, payment, investment, people use it in different ways. And now with Genius, it's being treated as a cash payment instrument under that legislation, and no yield can be paid to holders. This is sort of a framework to separate it out. Where do you stand on not necessarily the Genius stuff, but if people want to, one of the reasons people will want to engage in stablecoins is because of the yield capabilities that it can have, including the corporate treasurer community, of course. So how do you service that? How do you see the legislation panning out? What's going to be the developments there, in your opinion?
I think the debate on providing yield on stablecoins is going to be a tough one. I can, to an extent, see the arguments on both sides. At the moment, and kudos for this goes to an African oil importer treasurer who sort of pulled the wool from our eyes. So as you would imagine, we said to him, so he's importing oil from the Middle East and he's using Tether. And we said, well, how do you feel about the fact that Tether doesn't pay any yield? He said, I don't care. And we said, well, hang on a minute, what? Why? He said, well, if he makes the same cross-border payment with his local currency, that then has to be converted into dollars, which takes, I don't know, a couple of days. Then it goes into the Middle Eastern currency, which takes another couple of days. And the deposit that he's placed in his local bank is a demand deposit. So his local bank's not going to pay him any interest on it anyway. Also, from a credit risk perspective, his local bank is capitalized at 12.5% on a good day. Whereas a stablecoin, and he put this really starkly, he said, let's just pretend that if I use USDC or USDT, doesn't matter, if I just pretend they're all criminals and half of the money is gone, they stuck it on black here in Vegas and it's just gone, 50% is there, 50% capitalized is still 4 times better than my local bank. Plus, if I'm using the stablecoin, I'm only going to have to be exposed to it for somewhere between 4 and 8 hours. That was his average transaction cycle to buy stablecoins domestically and send those to the oil exporter. Done. So his exposure is intraday. He can then redeploy his capital much more quickly into something useful. And he wasn't getting paid any yield because whatever the percentage is, I don't even know. It's sort of some ridiculous percentage of deposits globally pay no interest at all. And then another ridiculous percentage pays next to no interest. I mean, I have a savings account in the UK that pays about 0.25. I get the usual sort of advertising, watch your money grow. Like, really?
At a very slow
glacial
rate.
pace.
Grow bored, waiting for interest. So, I think all of this is context driven, I think. In terms of the debate around providing yield, I could see arguments in favor because if I'm sitting in Argentina, I would love to be able to take my stable coins and earn yield on them. I would like that to be as simple as possible. If the stable coin is just paying interest daily without me having to do much thinking, then great. But if necessary, I might need to apply a bit of brain power and then go and use someone like OpenTrade, for example, or I can stick it into Coinbase. They pay yield on USDC. So I think the market is already just going, you can kind of put any barriers you want. But again, from a consumerist angle, consumers are demanding this. This is what they want. And I personally, I know this is ironic coming from a chap who's worked in a bank for 16 years and is owned by a bank. I think a lot of banks have just been earning a free lunch, particularly from the correspondent banking system. There's rent seeking all over the place. And what I would love to see is for a lot of that to be put to an end. I think there is definitely businesses to be run, but I think to be run much more constructively. And hopefully we can all get to a point where, for the first time since 2008, we can proudly announce that we work in financial services and not feel like a pariah at the dinner table.
That's true. It's true. There's one, actually, you raise a good point in that example, which is ultimately, and this is sort of the difference between stablecoins and I guess tokenized deposits, which is that, ultimately the stablecoin is a fully reserved product, effectively a narrow bank issue, if regulated correctly and administrated correctly. Whereas a tokenized deposit is, you're back to the same sort of fractional reserve banking that backs it in the normal banking system. So, you have to do your credit risk analysis versus, issue versus issuer, whereas there is more hypothetical fungibility and harmonization between a bunch of dollar stablecoins than there is between a bunch of dollar deposit tokens of various banks, because that's a very different risk spectrum. So, interesting.
No, certainly. I think people don't really appreciate, too many people in financial services, the simple ones think in terms of explicit costs. How much is it going to cost me? What are you going to charge? So that's your FX spread. That's your transaction fee, all of those sorts of things. And some of them might be hidden, some of them might be overt, but that's an explicit cost. The slightly more sophisticated people will think in terms of implicit cost. So that's the corporate treasurer in Africa. So he's thinking in terms of what's the probability of my bank going under compared to a stablecoin going under? What's the time duration that I'm exposed to this thing? So what's the probability again of loss? And also, how much of my capital is just tied up in making payments? It takes me 5 days. You're thinking in terms of hours and days of capital employed, which is how corporate treasurers tend to think about these things. The third one that I think too many people in certainly wholesale financial services, and this is, credit to the West Coast guys that sounded like I was denigrating earlier, that I think they get, but I think wholesale finance really doesn't get, is the psychological cost. So financial services, particularly correspondent banking, is kind of ironic because it's one of the few industries that in many ways got worse over the course of the last 10 to 20 years. I mean, I'd probably lump airlines into that bucket as well. But if you look at most other industries, phones are getting better, the internet's getting better, my laptop is lighter, and so on and so on and so on. Most industries you would expect to be on a positive trajectory. Finance and correspondent banking, ironically, for many countries, has got worse. Prices are generally going up because as there are fewer and fewer providers, the price sensitivity goes down, so you can charge more and more and more. So it's a slightly ridiculous state of affairs. But what that has led to is the psychological cost, because increasingly when you make a cross-border payment, you feel like you're placing a bet. Pay. Is it going to settle today? Tomorrow? Maybe a couple of days, don't really know, or it might get stopped by some random outsourced AML service center, some person who goes, well, I've never heard of Kenya because I'm sitting in Podunk, Texas, or wherever I might be sitting, and sounds like terrorists, I'm just going to stop that payment randomly. I'm sitting there, I'm going to my local bank in my African country going, dude, like, where's my payment? And they're going, not me, it's, clearing bank in the United States. Clearing bank, if I can ever get them on the phone, they're going to say, well, you're not my customer, terribly sorry. And even if you were, I can't tell you anything because that's tipping off. So then you sit there and you go, who do I take to court? How do I get this thing unstuck? I think we've all had this. I send money home back to the UK and, my Revolut, I'll call them out because they really annoyed me, stopped my payment for 5 days. And in spite of the fact that I've been making the same payment for 15 straight months in the same quantum to the same account. I mean, it's just badness. Having already provided my pay slips and my contract and all that sort of stuff, that one, we're just going to stop it. So you have this psychological cost when you make a payment. You think, oh my God, where is this thing going? Is it going to actually settle? Fix those three costs. And I think blockchains, for example, massively address that because they're going to be very quick. If someone's not delivered, you can't say, oh, I'm sorry, I've instructed to deliver to you, but the bank must be taking too long. If someone's paid you stablecoins, they don't have a leg to stand on because you can go, no, mate, sorry, where's your address? And show me the transaction because I'm going to go and check it on chain. Oh, yeah. Right. Now you've really got a problem because someone's trying to rob you. Blockchains, stablecoins that sit upon them is the Uber map of finance. This is completely underappreciated. Okay. Uber maps don't make taxis faster and they don't make them cheaper, but they tell you where the car is. So you don't stand like a psychopath staring out your front window thinking, am I going to miss the flight? Where's the taxi? Should I call them? If he gets here, am I going to have the right change? Is he going to stiff me for the change? Instead, you just look at the map, go, I got time for a quick espresso. I don't need to worry about any cash. He's going to rock up and I can walk out of my door literally as the car's driving up. I feel like cars are so safe from the usual suspects. It'll look really cool if anyone's watching. And off I go to the airport. That's what blockchains and stablecoins are.
I love that. Stablecoins and blockchains are the Uber maps for financial services. I think that's a great note to end on, and I'm sure there's a lot more to unpack there, Nick. I'm pretty sure we'll have you as a guest the next time, and we'll unpack some more for sure. But thank you so much for your time today. It's really been enlightening to us, and I'm sure the audience is gonna get a lot from this, especially the corporate treasurers who hopefully will listen to this and be like, I understand what I should probably be doing next, which is calling Zodia Markets. From that perspective. So, Nick, where can people find you for more information?
So I'm on LinkedIn, obviously, but otherwise it's zodiamarkets.com. Nice, easy to remember. So it's just like Zodiac, but without the C at the end. Zodiamarkets.com. Or you can ask Standard Chartered. They'll point you in our direction.
Thank you so much, Nick. And thank you, everybody, for listening to the Stablecoin Podcast today. If you enjoyed the conversation, be sure to subscribe, and new episodes drop every other week. Thanks.
Thank you.